Hello, my name's Simon French and I'm Chief Economist at Panmure Gordon. Today we're going to talk about the recent messages we've been getting out of the US Treasury yield curve, and specifically the first inversion that we've seen in that yield curve before the crisis, since 2007. And it has been such a strong indicator when the short rate is higher than the long rate in the Treasury market, such a good indicator of recessions, that it has caused some anxiety in risk markets. And we saw the biggest one-day sell-off in recent days of the year taking place as a result of some concerns that this was a precursor to a US recession. I think I would cite two reasons why what has been a very good indicator in the past of a US recession may be called into question by investors this time round. First of those reasons is the real rate on credit, so that is the interest rate minus the inflation rate, is actually just 0.5% over the 3-month Treasury. And that suggests that credit conditions for households and for businesses in the US economy are not actually that prohibitive. And one of the histories of the yield curve inversion is normally the real rate of interest when inversions happen is about 3%. So much more prohibitive reason to take out credit. So first reason, there isn't as big a disincentive to taking out credit at this point in the cycle. And the second reason, of course, is that across the world over the last decade, about $24 trillion worth of quantitative easing, i.e. money printing by central banks, has taken place. And that, allied to the requirement for more regulatory capital amongst financial institutions, means that it isn't necessarily telling us the same signals that the long end of the yield curve is well bid. Indeed, it may well be that a lot of the asset matchups that need to go on by pension fund managers, by financial institutions, some of the inventories that regulators are asking them to hold, means that even though it may well be that with the short end, with the Federal Reserve raising interest rates, you'd expect those interest rates to go higher at the long end, based on the sell-off. Actually, financial institutions, the big buyers of US Treasury debt, are not actually ditching their long-dated bonds at that point. So I think two good reasons to expect, or to at least to be sceptical about what is going on in the US Treasury market and whether that is indeed a precursor to a recession in the world's biggest economy.